Yeah, difference between being like a trader and being a long-term investor. We're not out there. When we've got our long-term hats on, we're not trying to make a quick buck.
My conviction is like, this is the stock that's going to make you money or more money or something to do with money, right? But this is what's going to pay. So there's that kind of very high level. But then there's all these nuances, because when I look in my own portfolio, there's different kinds of companies.
Like essentially, big tech is running the country in essence. So like the regs are off. It's a free for all.
My conviction is that the risk reward here is to the benefit of the investor. And I'm sort of, I'm betting heavily that that's going to be the case because I've done my due diligence and so forth.
For an advertising-free version of the show, check out patreon.com/Wall Street Wildlife. Welcome to Wall Street Wildlife with Christoph and Luke. This week, Coatue just published their Fantastic 40 Growth and Innovation Index, which is a list of the 40 companies they believe are best positioned to lead in an AI and tech-driven world by 2030. What did they pick and what are they missing? Plus this week, what does it mean to have conviction in an investment? And we've got a whole bunch of market news for you, including a rumored acquisition of a company I only just bought, plus some thoughts on recent results from Tesla and Novo Nordisk.
All right, let's get to business, Badger. Tonight is, for this monkey, the biggest day of the quarter because it's EOS earnings eve. And so you know that in my King of the Jungle portfolio, I'm like 40% or 45%. I got a puzzle for you. I got an interesting question. Get your honest take. You haven't heard this ahead of time.
I mean, context, right? I know nothing about EOS,
Yeah.
except that you forced me to buy $1,000 option in it because I lost a tennis bet against you.
That's right. I've forced you into ownership. Here's my question for you. There's a little bit of drama, which is that its financial partner, Cerberus, is they set up these milestones, and there's a threat of dilution if they don't hit the milestones. EOS has hit 15 out of the 16 milestones. The last one is a sales milestone, and they kindly extended this milestone so as not to appear as punitive. That's when we knew as investors that they're not there as piranhas just waiting to take advantage of them, right? So tonight, we're going to find out what happened, whether they met this milestone. If they did not, then there's going to be something like a 1% dilution penalty or something like that, right? So
because the guys who gave them the loan, like they're then legally allowed to like call in the warrant or whatever it is they've got.
correct. So that's kind of the setup, right? So obviously, I think in very binary terms, if they hit the milestone, market reacts positively. If they miss it because it's sales, it's not going to be a good look on anybody's part, plus the dilution, right? Here's the interesting tidbit. I believe yesterday we found out that the CEO just got a pay raise approved by the board, and Cerberus sits on the board. So, pop question: ahead of this earnings, how likely is it that they missed the milestone while at the same time granting the CEO a pretty decent pay raise?
No, these things are not remotely related, and you're smoking something if you think they are. You and your battery heads.
Really?
Yeah. Why do these two things have anything to do with each other, right? Okay. I mean, I have no idea about comp, right? Was the CEO like the founder? Like, what's his stock ownership, and what proportion of his remuneration is like salary versus stock awards?
I know he makes, so the salary raise, his base was 600,000 and it got bumped up to 800,000 and approved. I don't think he's a major insider owner. I mean, he during the peak trough of are they going to make it or not, he was signaling confidence in the company by buying shares on the open market, something like 50,000 shares or whatever, so 100K's worth but other than that, he's not one of the major owners.
All right. Well, stand by that. It's immaterial. Like, salaries are up in tech like driven like Meta have just like done something ridiculous with like the literally like the $1 billion salaries they're giving to AI researchers. I know that's nothing to do with this, but like salaries in that world are increasing faster than inflation in the US particularly. And like if anything, this might be a bearish sign because maybe they missed the milestone and maybe the CEO has like, he's like threatened to leave and they've had to like hang on to him by giving him like an out of band pay raise. But I don't think that's the case either. I just don't think it tells you anything. It just tells you like if there's like a thing that would be a better indication, I think, would be yeah, like buying or selling behavior or stock awards or something like that. But you probably wouldn't see like stock awards if they're material outside of quarterly reporting because they have to file some stuff if it's material. So yeah, I mean, I don't know.
Okay.
You guys, right? There's so little to actually pin proper due diligence to with like tiny little companies like this. You guys love jumping on like any snippet of news.
I firmly disagree. And of course I would say that because you know, uh, but s- try and be as objective as possible. It seems odd. It seems like it would be a very bad look to have a company underperform after the second attempt, and for the guys basically in charge of the company to say you underperformed and therefore we're gonna actually not just reward you.
But see, in the UK, right, this has been in the headlines in the last couple of months. The CEOs of a number of like national scale water companies of like one of them, I forget the details, got like a significant pay raise and bonus, and they've missed some really, really significant environmental milestones, and the company's going to get slammed because of that. But the leadership team get rewarded regardless.
I
You
don't
know,
think that's the case here, and maybe it's because it's still a small cap, so we're not dealing with behemoths that are integrated in everything. We know the company just fired the chief financial officer after a very short period, and these guys at Cerberus are there. They do have this reputation for being cutthroat. I mean, it's not. That's why I think there was a lot of back
okay,
and forth. So
but there's cutthroat and there's like cut your own throat. Like if I didn't know about the CFO. If you've just exited the CFO, and if you then either exit or allow the CEO to leave, like that's a very bad look, and presumably like a big hit on their bottom line.
yeah,
So
CEOs. No, no, no. This is his whole life. This is not one of those situations. This is just what he does now. So
okay.
interesting. You're saying immaterial, unconnected, and I'm reading it as almost. I don't know. I'd put it at like 80% probability. Like it's given me way more confidence than I had. Otherwise, they would have kept the salaries the same, or wouldn't have announced it, or whatever, wouldn't have to just
Yeah, these. I mean, I don't know about tiny companies, but in most companies, these are like regular processes. There's like an annual pay review, and the CEO follows the same process as everybody else. Otherwise, everybody else gets pissed off. So, there will have been a review scheduled for this time, irrespective of whatever milestones. Hey, look.
yeah,
Anyway, I know I didn't give you the answer you want, but people don't listen to this podcast because we agree with each other. They listen to it because we attack each other's ideas.
yeah, okay, great. So we'll find out tonight. I'll let you know, but you're basically saying they're just not correlated, and I'm saying it gives me an additional sense of confidence, so much so that I might buy a couple of degenerate lotto calls. Do not do as I do, or don't follow me. This is in the definite gambling degeneracy bucket, but
There's one thing we can agree with:
but
do not do as you do.
but monkeys ears are tingling. So we'll see how this works out. You had some
All right.
news. You had some fun news. Based,
Yeah, like, oh, is this I'll frame it as a question to you. So there's a cybersecurity company I've talked about a little bit in the last couple of weeks. I bought an investment in. CyberArk, who are like Gartner and Forrester leading technology around like authentication and authorization. So a particular part of that world, but very important world. Uh, and there's rumors, I don't know how substantiated they are because they were literally just last night, that Palo Alto Networks, who's one of the giants, might be making an acquisition offer for them. And so the stock's bumped up 13%. So is that a bullish signal? Or is that, what do you think about when you see these things which aren't, I don't think there's been like a press release. I think it was like a leak or something, I think.
Well, what's interesting is that this is the second one we've heard about because Sentinel-1 had the same thing kind of happen. I didn't follow, right? But that was a 20% pop and nothing was announced. So I think something's in the water. Probability wise, I would give this more like a 60-40 in favor of this being an actual thing. So in terms of poker, it's not nothing. It's definitely a signal. You just can't bet the whole farm on it. And I think it confirms that you're onto something, that you're sniffing, that there's something in the moment, right? That the stars are aligning for the macro forces and for the M&A stuff happening. And so it has me more interested than ever in doing a deeper dive on both Cyber and Sentinel, and maybe another adjacent company that fits the sort of to be acquired mark.
Yeah. I know you were looking at Rubric, which was like, that was on my radar when I did my preliminary research. Like a couple of thoughts on this as well. I agree with what you said. Like a few thoughts on this generally. M&A, like mergers and acquisitions, have been constrained over the last couple of years because US regs have been quite unfriendly to mergers, and now, like, essentially, big tech is running the country in essence. So, like, the regs are off; it's a free for all. So anybody who's planning like a big acquisition like this now, they'll dust off the papers and they'll start thinking about that again. It's quite expensive. Like Palo Alto, if it's true, Palo Alto, their market cap today is about $130 billion. Yep. And the rumored acquisition price is $20 billion. That's a chunk of change. And it doesn't mean they're going to have to find like $20 billion in like unmarked bills. It means they'll issue stock and they'll give like equity in Palo Alto to the guys that they're acquiring, and there'll be some sort of probably money plus non-monetary stuff that goes on so the acquisition can happen. Because sometimes even smaller companies take over bigger companies like that. So it's not impossible for stuff like that to happen. So it's certainly credible, and it also plays to Palo Alto's strategy because they have done some major acquisitions, and like I own both Palo Alto and CrowdStrike. They're both leaders. I always kind of favored CrowdStrike's technology strategy because it seemed much more kind of consistent and like one thing that you plug into like with an agent and then you have access to all this stuff. Whereas Palo Alto seemed to be more like they've tried to like smash loads of different tools into one box and call it a platform. But so there's a bit of like marketing BS around that. Like it is just a bunch of disparate tools to some extent, is my understanding. So anyway, like very credible.
It has me, if nothing else, interested in potentially buying a little cybersecurity bucket in which I would put the three potential acquisition targets. And worst comes to happen, they pop a little bit, and
You probably, maybe you've missed the boat a little bit with CyberArk. I did actually. I said on the Patreon last night because we were chatting about this in the Jungle Lounge. Like normally, I'm actually a bit miffed, like mildly upset. British term there. If one of like a company I own is the target of an acquisition, because I've done all this work and I know the company, and I don't love it, but like I feel like I've earned my place as a shareholder, and then someone comes along, snaps it up, and I get like maybe a 10, 20, 30%, 50% bump, right? But that's not why I'm an owner, to make a 50% return. I'm an owner because I want like 100 times return in 10 or 20 years time. So that story is over when the company gets acquired. But in this case, I'm kind of chill about it. Like the stock is up 13, 14% overnight. if the acquisition closes, maybe I'll end up making like 20 or 30% on my investment from a few weeks ago. I haven't done much work on this one. It was a starter position. So, yeah, happy to take the win and just go, yeah, okay. Just means I've got to find another stock. Like you're saying, like you want to get some cybersecurity. Like that's a priority right now for me. So I'd have to go and find like a different company.
Yeah, this is a hard thing for beginning investors to understand. I know I was confused by it for years. Like, stock pops 40% and people are upset. No, like how could that be? Well, there's a difference between, entering a casino, pulling on the knob, winning, you have a little bit of euphoria and you're like, cool, versus putting in, like you were saying, hundreds of hours of work, intending to be an owner for 15 years, and
Yep.
then it gets snatched out from under you for a mere whatever little pop. Uh,
Yep.
the best I could think of right now is like if Relay Therapeutics, for example, was bought out for something like $2 billion, like that would be like a 3x or something. Like that would be a disappointing outcome based on my expectations for like a decades long compounder. So
Yep.
yeah.
Exactly. Exactly. Yeah. Difference between being like a trader and being a long-term investor. Yeah. We're not out there. Well, when we've got our long-term hats on, we're not trying to make a quick buck. So today we're recording. We're a bit ahead of ourselves because we've got like our part two King of the Jungle deep dive already recorded. It's going to go out next week. So today is Wednesday, the 30th of July, and you'll be catching this episode in about 10 days' time. So this news will be a little bit dated, but last night, Novo Nordisk announced results. They've substantially cut back their forecasts, and as a result, the stock has sold off like 20 or 30%, I think, overnight.
Right,
Yeah.
on top of a sell off that for a while. So here's my pop quiz question for you, and this again has nothing to do with like these fundamentals. This has to do with just adding an extra bit of reasoning to whether to buy now or not. When you look at this chart, Badger, can you see like a painter would a pattern or a couple patterns?
Like, I don't know what all these squiggly lines mean, but clearly, like the valuation has gone down and the volume of stuff traded has gone up. I guess that's my amateur view of
So
what
let
I'm
me
looking at.
actually back up. Each one of the lines, if we're looking at the top picture, it represents a time, 1 month. So this is actually 7 years now of this of Novo's price history. Do you see a pattern in what the in terms of directions?
Yeah, of course. Yeah, it's like on a massive downward trajectory.
Okay, so let me add a little granularity to that. I see three patterns worth paying attention to. There's the pretty much uh, pattern that goes looks kind of like it's straight up from 2018 until about 2024, and then there's the obvious reversal of that pattern from about 24 till now. So it kind of looks like a hill, right, with a peak. But I also did notice that there's about a year in which the stock traded sideways from, I don't know, it looks like July 21 to about July 22, like a flat plateau, right? But that ends up being sort of immaterial. Why I'm using this now to answer Barry's question is, should you buy now? And my answer to that is no. And it's because in this kind of long term view, we could see that these patterns tend to last a long time when zoomed out. So from 18 to 24, it's kind of like if it's an up pattern. So if you say, do you buy now? I say yes, because it's you're working with the pattern. You're swimming with the momentum. Now there's a clear reversal and it's not going uphill, right? It's going downhill. So the only way I would recommend Barry to buy stock now is if he was, I would call a domain expert, or if he's done his really due diligence and he could confidently explain why this market reaction is, so to speak, why it's an overreaction. He could point to like with confidence. I can't do that. I have no fundamental understanding beyond the headlines, right? So I cannot tell you that the legal uncertainty, blah blah blah, is an overreaction because I know X, Y, and Z. All I could tell you is that the market is going to continue now in this direction until there is that reversal. And when that reversal happens, the price will then show it because it's going to go up a little bit. And that would be when you would take a much more de-risked, or call it, you would make an easier trade after it sort of has a little bit of a pop and that momentum starts going the other direction. Otherwise, the probabilities are in favor of this dropping further. So it would be more of the catching a falling knife thing.
Yeah. No, totally agree. But and so maybe if we like, so I guess the it went over the peak in, I suppose, about a year ago, like looking at the axes. So kind of July, so say Q3 last year. It's been in this kind of, the market cap has been descending since then, and so but that's like looking in the rear view mirror. But you're saying, like, not ignoring any other actual due diligence and understanding, like that's a signal that you should just like keep out of this until the curve turns.
Right.
Yeah.
And so one more, this is where that flat bit comes in. One more little
Yeah.
piece of hidden evidence here, or not evidence, hidden, I don't know, it's a crime scene, right? We're trying to make sense of it. Do you see that for now, that the price ended sort of exactly at the level of that horizontal flat plateau from 3 years back? And if you look on the right side of this chart, there's that vertical set of bars, and those mean that the longer those bars are, that's where most of that volume happens. So it's almost like shelves. It's the more volume where price happens, the stronger the shelf is.
Oh, the horizontal
I'm
bars,
sorry,
the
the
blue and
horizontal
yellow
ones,
thing.
the ones
Yeah.
in yellow and blue, right? And
Got it.
so
Right.
to me, this means one of two things. The price logically stopped at that shelf, which also happens to coincide with that plateau. That's why the shelf is there, right?
Yeah.
And now, were the price to actually break through and go further down, then there's still a lot more it could go down in terms of momentum. So I would, as it keeps falling down, I would not. I would continue to stay away. But if we see the price stabilizing around this point, that's more evidence that it's kind of, that's as low as it's going to go. And of course, we don't know, but then it would be more of a, okay, it's not going to drop further. Than if you study the company, you have more evidence that the next thing that's going to happen is that back to the upside. So
All right. Like, I won't argue with any of that. I get it. I don't put any stock in this stuff, really, because because I've the only thing I'll look at is actual, like the stuff we said. If Barry hasn't done these things, like those are the things you must do, and the price tells you. In my sort of badgers don't bury their head in the sand, like they dig holes and climb into their burrows. In like my badgers set, they have sets, not burrows. In my set, like we don't allow these like guys through the door when they're selling these kind of charts. You want to like come into the badger set and talk stocks. Come armed with like due diligence on exactly why, what's happened, why has the company reduced their forecasts, what's competition doing, and then you can have a
exactly.
sensible cup of tea
Right,
with the badger.
exactly. But that's my sort of challenge to Barry, if
Yeah.
or and our group, right?
Yeah.
Unless you've done your work and you could explain to Monkey why
Got
the
it.
market is
Yeah.
overreacting, then the chart tells you to stay away.
Yeah, that's okay. Good, good. Right, I think we're definitely saying the same thing. Yeah, yeah. So bad Barry, don't, like, you've done it now. You've done it, so don't make things worse by suddenly panic selling it. You've made that decision. I guess you just like, ride it out and maybe learn from it, and maybe it works out, maybe it doesn't. Who knows?
Speaking of not working out, you want to talk the Tesla earnings real quick? There was something that it's not that it was weird. It was a little unexpected what happened. So I listened to the Tesla earnings call. I looked at the shareholder deck, and I think by all objective measures, if you look at the financial picture, I don't know. The vomit face is the best I could come up with, because for a company that is still, I would call, in its young growth phase. I mean, electric cars, they're by no means the established thing. To have sales revenues down year over year 16%, to have the energy storage sector down, to have gross profits down, to have margins down, to have operating expenses down, operating margin down 2.1%. I mean, everything in this column is down. Free cash flow is down 89%, but I don't care because they're obviously investing using that
Yeah.
for capex. So that's a huge number, but I'm not phased by that. But I mean, it's down across the board, right? Which we talked about this, we sort of predicted. And then the first thing that happens next day is stock drops something like, I think it was like 7%, 6%, something like that. And then over the following couple of days, it's kind of back up to where it was pre earnings. This tells me there's no other way really to, I don't know, justify, explain it to myself, is that this stock is being held and controlled by the large institutions. And the large institutions are primarily saying, we believe the long term story that Musk is selling, far above and beyond what the financials show for the current company as is, which is a car company slash.
I agree with you, but I would challenge the large institutions. I think Tesla retail investors are more than 40% of the ownership of Tesla. And actually, like, unfortunately, it's like retail. Most people don't understand or do the numbers. They're driven by the story and the narrative. And that's probably why this is such a narrative driven story, not a numbers driven story.
Okay, so fair enough. Whoever controls the stock, you're saying, is okay. I just This just got my ears a little bit, perked up, because to have a high premium like Tesla does, it's not pre-revenue like ASTS Space Mobile, right? It's not. It's already in past the early innings of its story. For these numbers to be this bad, and for the stock to basically not change, means to me there's already evidence that's shifted into more of a story stock than a company founded by any fundamentals. Otherwise, right, this kind of deceleration would just be outright recognized as bad news.
Nothing new there, right? We've been saying that for a long time. You either buy the story or you don't.
Yeah, and I guess I'm saying I'm just surprised that the stock recovered.
Yeah, yeah, yeah. But that you're like, I'm agreeing with what you're saying. Like you, but it's not. I suppose it's not surprising the stock didn't really move in essence because the story didn't change. It's just the numbers changed, and the numbers haven't made sense for some time.
Right, and yeah, so I don't expect. I think we talked about this too. I don't expect the numbers to be much better this coming quarter either. Right, there's none of the story bit is still coming into play. Uh, the tax credits are going away. So the company is more expensive, I think, than ever. Really.
Yeah, yeah, yeah. Totally. That's totally true because the market cap stayed at broadly the same level, but the sales have like dropped off a cliff, and so then your valuation ratios really start to go out the door when like these year over year numbers get ugly.
Yeah, though I'm not sure. It's Yeah. I don't know if the sales dropped off a cliff. I don't know if that's the expression I would use, but it's enough for me to see all these negatives that obviously are a pattern.
Mhm.
And for a company at this stage in their growth cycle to be already sort of post peak, it doesn't need to be a cliff. It just needs to be, on the other side of the peak. That gets me thinking, well, how quickly will that reverse? And if storage is now facing tariff headwinds from China, what reason do I have to be confident in my holding this company right now?
Like maybe to me the most fright. I haven't really gone into the numbers because I said like the numbers are almost irrelevant. But the one that will frighten me the most, just looking at this picture you've thrown up, the one that frightens me the most is gross profit margin down 15%. Like that, there's something else wrong. It's not just about fewer sales. It's about, and it's not about like capex and preparing for like robo taxi and other lines. Like the cost of each car is individually less profitable for them. Gross margin is down 71 basis points, which is just under 1%. But even that, what I said stands down 1%. The cost of each individual car, or the profit of each individual car, has dropped by 1%. That is like there's something behind that number that we need to understand.
Right. So I am not incentivized to buy any more shares here, even though I have. It's one of my 14 in the King of the Jungle portfolio.
So just this morning, I got a WhatsApp from a good buddy who said he had sold all of his Tesla stock and had plowed the money into Alphabet. So I'm like, you made one really good decision there and one decision I'm not so sure about. So, like, I don't know. Are you tempted to sell your Tesla stock? But you don't really have any, do you?
I'm using King of the Jungle as a good proxy for what we talk about, and I am not tempted to sell that position. I like it in my portfolio. In fact, there is something I liked. This is one of those big picture things that mattered to me quite a lot, especially a company like Tesla. When you add up all the things that equal, like what is Tesla, I am quite bullish on all of it. You see here, I like that they name manufacturing, like the factory itself is something that Tesla is. They obviously have an edge there. And when you combine that with the bots, right, when you then add the trucking that's coming and their, massive investment in AI compute and the storage and the home charging and the batteries and the robot, like this picture tells a really really nice story, but to me it's like a decades long story, and that's why I'm just not going to sell out. The story's too good despite the current moment's financials.
Yeah. Like I've got a relatively substantial position in Tesla, which I'm not touching right now. But yeah, I've decided just to kind of hold my nose on this one, ignore what the stock does, and then just see what happens. Like a piece of news that really surprised me, honestly, that I just saw in the last week, is that apparently Tesla are now testing proper FSD, not the garbage we have currently in the UK. So that's actually exciting. Like if they roll out what you have, like FSD beta, I'll probably pay for full self driving again on my car because I've got like the new hardware 4 car. I'd like to have that, and I think that will sell well. I'm shocked they're doing it in the UK. I can only guess that because I suppose like this is a driving on the left market, so I suppose that's like a bit harder than just going into Europe where it's like at least you're driving on the same side of the road. So some of your learning might be relevant, even though like the street signs and everything are totally different. But I guess it's maybe a benefit of Brexit and maybe slightly different regulatory environment, and the fact that Keir Starmer is buddying up to Trump and presumably isn't going to like slam Tesla when they start murdering British people on the roads, just like like because that is the natural trajectory of any of these companies. Unfortunately, there will be accidents, but the idea is there'll be fewer accidents eventually than like an all-human driving thing. So that's just like a collateral damage, unfortunately. So yeah, anyway, surprised that they're coming to the UK and excited about that.
Yeah, no, that's good news. I mean, the only, I guess, tricky thing about this for me is that obviously the market will pull forward the expectations about autonomous driving. So even if it won't show up on the balance sheet, once something like what you're talking about happens, then the market senses it and the stock is liable to go up. So that's why probably not selling, at least completely not selling out, is the right move here.
Okay, I've got one more tiny bit of market news for you before we move on in our schedule. My brother right now is live drinking a cup of Greg's coffee, and he agrees it's god awful, to quote from the WhatsApp I just received. But he's enjoying the sausage bap, so that aligns with my thesis.
Go back to and listen to our portfolio reviews to hear Monkey's take on why Badger is out of his mind for having invested in Greg's sausage rolls. Your Greg's is my EOS. I think that's it. That's our now.
We are doing like we're having a bit of fun. So, I mean, I'm going to promo like the last two episodes, part one and part two. So, Christoph and I did a ton of work. Between us, we own 30 different companies in our King of the Jungle portfolios. And we went through every single one. And we had like a 10 or 15-minute conversation about every one. And it was good, like bull and bear kind of arguments about them. And I think that's resonating really well with our Patreons, and also on X and on YouTube. We're getting some good comments around those. So if you haven't checked them out, go check them out. And everything's like time coded. So if you're only interested in like one company, just jump to that time code. And if you enjoy it, like give it a like and a subscribe. That'd be very helpful. But we've also, like, I've spent like a slave. I've been badgering away, and I've made like a 1-minute short out of each of those 30 videos. And I published the first 15 yesterday. And of the first 15, the Greg's one is doing the best, just in terms of number of likes and number of views. So God knows. People like Greg's more than they like Alphabet and Coherus and all sorts of other stuff.
See, that's one of the problems with human beings. They'll latch onto something like a god awful coffee and sausage company like Greg's, but ignore life changing technologies. Anyway, but that's a nice segue to, we had a question from our Patreon that I think quite astutely looked at our conviction ratings and said, well, what exactly do you mean by conviction? And it's a great question because it's not a simple answer. Badger, do you want to take a stab on how you answer Paolo's question?
Hey listeners, my name is Brett Schaefer, one of the hosts of the Chit Chat Stocks podcast. On our show, we do comprehensive stock research reports, interview analysts, and learn from great investors. And we have coverage on stocks like Airbnb, Nubank, Mercado Libre, and many others. Plus, we cover all the hot financial news on our weekly investing power hours. We have episodes for all types of investors, and think if you listen to this podcast, you will enjoy ours as well. Follow the Chit Chat Stocks podcast on YouTube, Spotify, or Apple Podcasts, and start discovering new investments today.
Like I said, when we went through these 30 stocks, we also awarded them a conviction rating from 1 to 10, like 1 to 10 badgers or 1 to 10 bananas. And Paolo tried to infer what was the driver of our conviction from the results. I think he gave us a really good pitch, but let's just sort of reset how we think about this. And I think one thing we both did going into that prep was we said, like, our conviction has to reflect the valuation today. So, if Tesla had just reported terrible results, presumably your conviction has taken a knock, and that it should be reflected in that, because those last two episodes, like, they're timely. They're our thoughts right now. And I think it's fair to say, like, we would recommend a 10 badger or a 9 banana investment over like a 2 or 3, because we'll have higher conviction in those things. So the question is, from Paolo, like, how did we arrive at those scores? And for me, it's just two things. Like, one is my familiarity with the company, because if I don't really understand the company, by definition, in my mind, I cannot have conviction in it because it's not founded in anything. I don't look at stock prices. I look at company trajectory. So I have to understand the company. So familiarity. And then my other one is a bit nuanced, but it's my perception of like the risk-based return at the current valuation. So let me just sort of explain that, because Paolo looked at my ratings and said, well, Luke must love like these low volatility, steady, sturdy companies. And I do, no doubt. But the reason I've given like Alphabet and Amazon and Mercado Libre, my highest conviction ratings, is because actually I think they're reasonably valued right now, like today. And so, case in point, like Rocket Lab has had been on an incredible run. It was like a 12 bagger for me. It's now like a 10 bagger. It's given some back to the market, whatever. That was my highest conviction investment when it was like a $4, $5, $6 stock. But now it's like, well, today it's like a $45 stock. So, like, I do not like it, does not represent good risk based return because there's a lot of, a bit like Tesla, there's a lot of story and momentum because retail have suddenly cottoned onto the fact that this is an incredible company. So great company, but not such a good investment. So that's why, like, my hyper growthy type stuff, my more volatile stuff today is depressed in my conviction ratings. But if you went back to, say, 2022, when growth stocks were in the toilet, like those kind of companies were my highest conviction.
And on my side, Badge, I go back to we're in this as investors to make money. I mean, in the end, that has to be the outcome. If that's not the outcome, then all the other stuff and all the reasons why we do this is, it's not that it's irrelevant, but then we could think of it as a hobby, right? Or like a game we're playing. But no, like, so in one simple way of thinking about this, my conviction is like this is the stock that's going to make you money or more money or something to do with money, right? But this is what's going to pay. So there's that kind of very high level. But then there's all these nuances because when I look in my own portfolio, there's different kinds of companies. So Paolo is exactly right to say, well, if you have different kinds of moving parts here, then a conviction probably doesn't mean the same thing in each case. So I want to offer three separate examples of how I kind of fine tune what that means for me. Turns out that my four highest conviction ratings are all given to companies that I would call mostly pre-revenue. They're stories at this moment. So what I'm saying when I give them high conviction rating is I really, really believe the story. And therefore, I believe that the company will be worth way, way, way more than it currently is. But because it's pre revenue, that also means the risk is higher than something more established. So, kind of, I guess, in sum, my conviction is that the risk reward here is to the benefit of the investor. And I'm sort of, I'm betting heavily that that's going to be the case because I've done my due diligence and so forth. The second kind that I see my portfolio has to do with biotech. These tend to be these are in the bottom half of the portfolio. But to me, the conviction simply means that I think the market is missing or not understanding the data that is visible to those that understand the biotech. And why would that be? Because the market actually is kind of short term ish in the biotech world. They're not looking out more than 6 months, really. And so it seems like that's the case where I think I know more or better than the market does. And I'm willing to wait for the market or the data to prove itself. The weird thing, though, just I have to explain this because it's almost like its counter argument, I actually downgraded relays because I think the data won't be available for several years, and that in this moment, it's just going to be a lot of waiting and kind of dead money. So even though my conviction is very, very high about the company itself, there's not going to be much to move it. And so almost like the equivalent of valuation. It's like I have better places for my money right now. And the last nuance is for an established company, and here I'm putting AMD and Nintendo in this category. The conviction has to do with me believing the story, the numbers backing it up, the moment being right, and the valuation not being out of control. And so you put all those things together, and I think now's the time to enter the position with confidence.
Yeah, that's good. They all seem very reasonable bases to assess conviction on. I guess it means Or does it? Maybe it means your conviction changes more rapidly than mine.
Could be. It could be. Well, to speak to your point, though, I know I'm. It's sort of, I would want to reiterate something that you said. Across all of these, the trust factor matters, and you could only gain that over time. And so, another overlap, so to speak, because I've been researching EOS now for 3 years, even though it's pre-revenue, I know that company inside and out. So that's another one of these things I feel like I'm not going to flip flop about, because I've earned that trust, so to speak. So unless something breaks the thesis, it kind of helps. But something like AMD, which is new to my portfolio, I can't see giving it much higher than a 6 or 7, because I haven't been with the company for very long for it to have earned that conviction in this way. Yeah, I suppose you're right. I'm liable to make drastic moves in conviction rating more quickly than you are, because of the kinds of companies I own.
Like, say tonight, calling back to the top of the episode, let's say EOS do have missed this milestone. Like, what does that do to your conviction around the company?
That would entirely depend on the reason. If it's like because they screwed up, because,
Mm.
oh, oops, we overpromised and the demand is nowhere near what we thought, that would be a drastic change in conviction levels. I just don't see that happening. So that would be a kind of thesis breaker, really. But if it's something like, companies withheld buying from us because there was so much uncertainty around the legislature, the big beautiful bill, and it's going to be 3 months out, rather than the problem with the technology or incompetence or whatever, then to me it's just a temporary delay, and I'm actually going to add on the temporary weakness.
But then, I mean, this is like the investor call. I guess they get questions from analysts, but they're never going to tell like a terrible picture, right? They're incentivized to tell the sunniest possible story and, have excuses up the wazoo and analyze. Like, it's interesting. Like, you should definitely, when you do your due diligence on a company, you should listen to the earnings calls. And I mean, I don't mean like read the transcript, listen to the calls, because sometimes you hear something just in the nuance and the intonation and the actual conversation. And often I'll hear an analyst will ask like a kind of passive aggressive question. They'll get a bit of a flim flam answer from the CEO or whoever, the CFO, and then the call just moves on because like the analyst has had their airtime and it doesn't really get addressed. And if you were just reading the transcript, like you might not get that sense of what's really going on, might be able to read between the lines in that way.
Totally. This is something, yeah, this is like poker level stuff, like reading the table, right? I mean, it's amazing how true this is. It's kind of shocking, but to put it as bluntly as I did with regard to the chart reading stuff, if you get out from the weeds, right, and just really look at the big picture on an earnings call, the company is either really excited and like, no, we're in it, like we believe in our story. There's problems, but we're going to overcome them. Like, but they're they believe their own story, so to speak. And then there's the hemming, hawing, using fancy language, or like they can't hide, the the lack of whatever the problem is. And it's just so easy to spot, which by the way kind of is weird. It's why Tesla now their earnings calls are sort of tricky, because Elon is a tricky narrator. He's just a weird speaker. He hems and haws, and it's weird. Anyway, side bracket.
Yeah. Well, and he calls analysts dumb,
Right.
right? So then it's hard to argue with the richest man on the planet, like that. And if you fall out of favor, presumably you don't get invited to like a future analyst call, right? Because you don't have a right to show up. You have to get invited by the company and be, So there is a bit of, you scratch my back, I scratch yours in this whole thing.
Esatto. Badger, we are 50 minutes in. I think only our true fans are probably with us at
Yeah.
this moment. How was the Oasis concert?
Oh, dude, it was really good. Yeah, so I managed to get literally last minute tickets to Oasis on Saturday at Wembley. Um, I called like the one man who I knew in my inner circle would just go, yeah, like damn the cost, I'm in. And so Ramesh and I went on Saturday night. We actually like I was literally halfway to Wembley before I managed to secure a ticket. It was like that last minute. We're just going to go and we're going to make this happen. And we got incredible seats at a reasonable-ish price, albeit the lady next to me paid like a quarter of what I paid. But like, damn it, I got to
How
see
many
the Gandalf
sausage
on stage.
rolls did this cost? Tell us in sausage rolls.
Yeah, like
Is it like
I
a
don't know.
year's supply of sausages?
It was a sixth of what I was willing to pay, like a year ago when I was trying to buy tickets. It was like 460 sausage rolls each. But
So did the boys still have it? Like, how old are they? Do they? I mean, they're getting up there. They're not the Stones, right? But did they?
yeah,
Like
it was a good
good
gig. Yeah,
show.
it was really good. They are really good. Yeah, they are really good. There were concerns about Liam Gallagher's voice last year, but like they were assuaged, and they were kind of, there wasn't any fighting on stage. I mean, to be fair, they just kind of came out, did the set like workmen, and then like left the stage. So there wasn't like huge drama, but it was very good. It was really good,
Was
and
there any chit chat between like did they?
yeah, a little like you know 5 seconds of chit chat prior to each song, but no, no like we're back and like thanking the audience and like la la la. They just got the job done. But I was happy, like very happy with that. I thought I would never see this band. I was chatting to Ram on the way there, like super excited, and like in my mind, like I've missed like there's only one artist or one band I wanted to see more than Oasis, and that was Queen with Freddie Mercury. And I've seen Queen with Adam Lambert, and it's incredible, great show. Lambert, what a performer, but it ain't Freddie Mercury, and I'm never going to get to see that, barring some incredible AI innovation. So I'm just shocked I got to see Oasis again because I didn't think they were going to get back together.
Okay, well, right on. It was glorious to see you rocking out at that show. Meanwhile, I got myself to a convent in
Ooh,
southern Italy. We took a trip. Friends, a group of us went to explore. Yeah, the boot. We got off the island. That was kind of cool. Taking the ferry from southern Sicily over to mainland and exploring southern Italy. And yeah, we stayed in an actual convent because the friars, a Franciscan convent, the friars were out on vacation, and uh, for my soul, it's good to like be in a room with like just a bed, a nightstand, like the anti rock and roll thing. But there was no AC, and it was 100 degrees for one of the nights, so that was a little bit
okay.
dicey, but um, good experience.
I won't ask you. I've never really asked you about your like religious affiliations. But anyway, have your soul been cleansed in some way,
Well, no,
either
no, no.
philosophically or
I'm
otherwise?
actually happy to talk about it in part because this is what I wrote my dissertation on. So, and I have my philosophy Substack, and it's called Fire Philosophy, Zen, Nietzsche, and How to Live. And so, I wrote about Buddhist philosophy, I guess, in my professional academic life. So I'm happy to say that in as much as Zen is a philosophy, it has religious qualities, and so I'm a Zen guy.
Okay, but it's not Catholicism, right? So
No,
the convent didn't have any specific meaning for you.
well, I was raised Catholic in Poland, so there's that. But
Yeah,
I
right,
see
right,
it from a
right.
very different light now. But here's the thing: this is interesting. I want to mention this briefly. I spent a lot of my time there reading this book,
Mm,
"Open Socrates: The Case for a Philosophical Life" by Agnes Collard. Go check out my Substack, my Fire Philosophy Substack, firephilosophy.substack.com, because I did an interview with this author. But the one thing I want to bring to light here is that she basically tries to explain what the Socratic method is, and most people, I think, have the cliched understanding of it. Like Socrates comes up to you, asks you a bunch of questions, shows you what an idiot you are for not knowing, the answers. And that's like a cartoon version. But there's one takeaway I think that's really, really smart, that's useful for us. She starts the book by talking about Leo Tolstoy, author of War and Peace, and these great works of literature. And he also wrote some a biographical, kind of autobiographical confession in which he got really depressed after already being famous and having world fame and money and this large estate. And he was like, what the hell is all this for? But in that snippet, he's asking himself a bunch of questions. And she calls him out and says he's not really asking. It looks like he's asking, but he's not really, because he already sort of presumptively knows what the answers to the questions are. And she therefore says what Socrates does is that he really puts in a lot of work to generally ask what most people are not capable of asking. But here's the takeaway for you and me. One of the main takeaways anyway, is that in order to generally perform, so to speak, the Socratic method, you literally need a partner. You cannot do it yourself. And that's because there's the paradox of, call it, the eye is unable to see itself. It's the thing you use to see with, but you can't look at your own self. And we talk about this in different variants. But my takeaway, Badger, is this. I actually think, in as much as you and I challenge each other or try to, I think we could even get better at that. I think we not only can, that's obvious, we always could get better, but should make more of an effort to legitimately either refute the other guy or be refuted ourselves. And that is, in a sense, why this format I think is as valuable as it is, and why all investors really should belong to some sort of community or have a kind of investment partner to work with, because to reiterate, you literally cannot see the things you already believe to be true.
Yeah, that is you raised this when we had our conversation with the guys on the Dividend Talk podcast, and go check it out. We'll drop a link in the show notes. Really good conversation, great interview, and they kindly said we can republish it to the Wall Street Wildlife feed, so you'll be seeing that in the next week or two. And you raised the same point about your inability, by definition, if you believe something, to truly challenge that belief. Because if you're able to challenge the belief, then you didn't believe it in the first place. But it does boil, it's wordsmithing. It does boil down to your definition of belief. But there's certainly like a really good lesson there for investors. Investing is better with friends, and ideally better with friends who can give you, not just call you an idiot, but give you like constructive, objective feedback on why you're wrong about something, and give you like the true bear case or the bull case if you're bearish. And that's when you should open up your ears and listen, and not just like defend your position, because that's when you get your real understanding.
Right. And one other point, I think this is why when you read a bunch of Plato's dialogues, people get pissed off at Socrates because they're like, man, this guy's annoying, or he's telling me wrong. They read him as though he's just trying to make fools out of them. But if you take out your interpreting good questions as having anything to do with your own personalness or selfhood, and you only see it as an attempt to really see the truth, then anytime somebody refutes you or shows you why you're wrong, that's a reason to celebrate rather than to be pissed off. It's hard to do because we take things personally, right? But in an investing game, in the end, like poker, what matters is, are you making money or not, right? And not how you feel about it, right? So anyway, it's a great book, and I think it's going to encourage me to be even meaner to you about your sausages, so you could prove to me why you're right about them.
Yeah, and we did have a bit of an informal fun vote on our Patreon to ask, like, am I attacking Christoph too much? And everyone was like, no, do that more. So,
Yeah, right.
they want this shit. They want us to attack each other personally for fun. Obviously, that's just joking, but attack each other's ideas because that's how we learn. Yeah.
All right, shall we move into the last part of our episode, which is
Well, how's about this? Because we have just ticked over the 1 hour point. So we were going to talk about the CO2 Fantastic 40, and I've done a shit ton of work prepping that topic. So I want to give it proper airtime. Why don't we tackle that next week instead? Because it's kind of timeless. They've just published the thing, but like the information's not going to go out of date. And yeah, and then that'll, because you got some travel coming up, that'll give us a little bit of a buffer while you're sailing the seas of Greece. And then you and I are both going to be in the States in August because I'm coming over for the US Open and to catch up with a whole bunch of very, very good friends. And you're heading home to Austin.
That's right. I was so excited by this book on Socrates. I'm making my way straight to Athens to see where the old man did his dirty work.
Awesome.
Yeah,
Very
right on.
good. Right on. All right. Very good. Well, you have been listening to Wall Street Wildlife. If you enjoyed our conversation, do go check out our last 2 episodes because they are very good and they are full of up-to-date insight and due diligence and conviction ratings on 30 stocks we own in our King of the Jungle portfolio. But like, those are the same stocks we own in our real portfolios. Like, these are the companies we truly believe in, even the ones we gave like 2 and 3 badges and bananas to. Like, they're well worth a look. And if you go check out those episodes, we'll tell you why.
Are you ready to become a beast of an investor?
Your journey starts here.
A reminder that the people on this program may hold positions in the companies that are mentioned. Buying and selling stock carries financial risk, which could include loss of capital. The views in this program should not be taken as personalized advice. Before acting on any of the information provided, listeners are encouraged to consult a financial or tax professional.